Just a few years ago, money in America was almost free. Borrowing was cheap, mortgage rates were near historic lows, and investors were pouring money into stocks, crypto, and real estate like never before. It felt like the market could only move in one direction, up. Growth companies were valued at massive levels, startups were raising billions, and risk-taking was everywhere. But then something changed. Inflation surged across the United States, and the Federal Reserve stepped in with one powerful tool: rising interest rates. What followed has quietly reshaped the entire investing landscape in America. To understand what's happening today, we first need to understand why interest rates matter so much. When the Federal Reserve raises rates, borrowing becomes more expensive across the economy. Credit cards charge higher interest. But car loans cost more. Business loans become harder to justify. Mortgage payments jump dramatically. The goal is simple: slow down spending and bring inflation under control. But while this policy targets inflation, it also changes how investors allocate trillions of dollars. When interest rates were near zero, investors had very few safe options. Savings accounts paid almost nothing. Government bonds offered extremely low yields that forced money into the stock market. Investors were willing to take higher risks because there was no real alternative. High growth companies like Tesla, Amazon, and Nvidia benefited enormously during this period. Their future profits looked incredibly valuable when discounted at very low interest rates. But when rates rise, the math changes. Future earnings become less valuable in today's dollars. As a result, growth stocks often experience sharp volatility during tightening cycles. This is why we've seen a noticeable rotation in the market. Investors are shifting from aggressive growth strategies toward companies with stable earnings, strong balance sheets, and consistent cash flow. Dividend-paying stocks suddenly look more attractive. Value investing regains popularity. The mindset moves from chasing explosive growth to protecting capital and generating reliable returns. Rising rates create discipline in markets that once thrived on speculation. Another major shift has happened in the bond market. For over a decade, bonds were often considered boring and unattractive because yields were so low. But now, U.S. Treasury securities issued by the U.S. Department of the Treasury offer meaningful returns again. Investors can earn solid yields backed by the U.S. government without taking on extreme stock market risks. That changes portfolio strategy significantly. Instead of putting all their money into equities, investors are rebalancing toward fixed income. Bonds are no longer just for retirees, they're becoming competitive assets once again. Real estate has also felt the impact in a dramatic way. When mortgage rates double from around 3% to 7%, affordability changes overnight. Monthly payments increase sharply, pricing many buyers out of the market. Demand slows, housing inventory rises, and price growth cools. Real estate platforms like Zillow operate in a much different environment compared to the ultra-low rate era. Investors who once flipped homes aggressively are now focusing on rental income and long-term cash flow. Rising rates don't destroy real estate, but they fundamentally reshape strategy and expectations. Startups and venture capital have experienced another transformation. When capital is cheap, investors fund bold ideas with the hope of massive future growth. Profitability becomes secondary, but when interest rates rise, investors demand stronger fundamental. Cash flow margins and sustainable business models become essential. Venture funding slows, IPO markets cool, and companies that relied on constant fundraising face pressure. The era of prioritizing growth at any cost begins to fade, replaced by a focus on efficiency and profitability. Interestingly, there is one group that benefits directly from rising interest rates: savers. For years, Americans who kept money in savings accounts earned almost nothing. Today, high-yield savings accounts and money market funds finally offer meaningful returns. Banks compete more aggressively for deposits. Conservative investors who prefer stability now have options that didn't exist during the zero-rate era. After years of there is no alternative, there is finally an alternative. Beyond numbers and charts, rising interest rates also create a psychological shift. Low-rate environments encourage optimism, risk-taking, and speculation. High-rate environments encourage caution, patience, and selectivity. Investors become more analytical. Market narratives shift from hype-driven stories to earnings reports and economic data. Capital preservation becomes just as important as capital growth. This mental shift can be just as powerful as the financial one. So, what does all of this mean for American investors today? It means diversification matters more than ever. It means understanding interest rate cycles is critical to long term success. It means portfolios that worked perfectly in a low rate world may need adjustments in a higher rate environment. Growth stocks can still succeed, but volatility may remain elevated. Bonds regain importance. Real estate requires smarter entry points. Cash becomes strategic rather than idle. The big question now is whether high interest rates are temporary or part of a longer structural shift. That depends on inflation trends, employment data, economic growth, and future decisions made by the Federal Reserve. The markets will continue reacting to every signal. But one reality is clear: the era of easy money has ended, at least for now. American investing has entered a new phase where discipline, fundamentals, and strategic allocation play a larger role than ever before. Understanding this shift isn't just important for Wall Street professionals, it matters for everyday Americans building retirement accounts, investing through 401k plans, or managing personal portfolios. Interest rates quietly influence nearly every financial decision in the country, and those who understand how they work gain a powerful advantage. Rising interest rates are not simply an obstacle, they are a reset, a recalibration of risk, a return to fundamentals. And for investors who adapt intelligently, they can also be an opportunity. Image prompt 1.